Good morning, teacher and classmates. We are going to talk about the option contracts. So let's start.
My name is Elisa, and I am here for talk about the option contracts.
Hi, I am Joseph Salgado Mena and my ID number is 2020 40 11 28.
Hello, my name is Hugo, and my badge number is 2021 40 10 50.
My name is Ariadne. My ID is 2022402180.
My name is Ameliani and my ID is 2021 40 04 63.
My name is Pamela. My ID is 20214000323.
We are here for talking about the option contracts, which are financial instruments that belong to the group known as derivatives. These are called this way because their value depends on other asset, um, referred to the as on the underlying asset. This underlying asset can be a stock, an index, a currency, or a commodity. Option contracts are widely used in a modern financial markets by both individual investors and large financial institutions. Their popularity is mainly due to the flexibility they offer in managing financial risk and investment strategies. The importance of options lying in their ability to manage risk, take advantage of market movements, and design more sophisticated financial strategies. Unlike another financial instruments options, allow investors to participate in a market with a lower initial investment, since the buyer only needs to pay a premium. However, it is important to mention that options also involve risk, which must be clearly understood before using them. In this presentation, we will focus in two main types of options, the call options and the put options. A call option gives to the right to buy an asset, while a put option gives the right to sell an asset, but a predetermined price. Additionally, we discuss the different positions involved in the option contracts, especially the buyer and the seller. The buyer acquires the right with quiet obligation, while the seller assumes in an obligation the buyer decides to exercise the option. Underlining these positions is essential to fully grasp how options work and the risk associated with each.
I'm going to talk to you about the concept of an option contract. An option contract is a financial agreement through which a person acquires the right, but not the obligation, to buy or sell an asset at a previously agreed upon price within a specified period. The underlying asset can be a stock, a currency, a stock index, or even commodities. The most important aspect of this type of contract is the distinction between right and obligation. The buyer can decide whether or not to exercise the option, while the seller is obligated to fulfill the contract if the buyer chooses to exercise it. These characteristics is the foundation of how options function and their associated risk. Parties involved in an option contract. An option contract involves two main parties. Option buyer. This is the party who pays an amount called a premium. In return, they obtain the right to buy or sell the asset. Their maximum risk is limited to losing the premium paid. Option seller or issuer. This is the party who receives the premium and assumes the obligation to fulfill the contract. if the buyer decides to exercise the option. The risk can be greater depending of the type of option. The relationships explain why the buyer has limited risk while the seller may face more significant losses.
An options contract is made up of several fundamental elements that determine how it works and what its financial outcome may be. The main elements of an option contract are the underlying asset, the strike price, the premium, and the expiration date. The underlying asset is the financial instrument or asset on which the options contract is based. It may consist of companies' shares, stock indexes, currencies, or commodities. The value of an option depends directly on movements in the price of this asset. If the underlying asset rises or fails, the value of the options change accordingly. For this reason, it's essential to analyze the behavior of the underlying asset before entering into an option contract. The strike price is the price at which the option holder has the right to buy or sell the underlying asset. This price is established at the time the contract is created and remains fixed through its duration. The relationships between the market price and the strike price determine whether the option is advantageous for the holder. When the market price moves favorably relative to the strike price, the option is considered to have value and might be exercised. The premium is the cost of the option contract and represents the amount paid by the buyer to the seller in exchange for the rights guaranteed by the option. This amount is paid upfront and compensates the seller for the risks assumed. For the buyer, the premium represents the maximum possible loss, while for the seller, it represents the maximum potential gain of the option is not exercised. The value of the premium depends on several factors, such as the time remaining until expirations, the volatility of the underlying asset, and the strike price. Finally, the expiration date is the last date on which the option holder might exercise the options. Once this date is reached, the contract becomes invalid. In general, the more time remaining until expiration, the higher the value of the option. Since there is a great chance that the price of the underlying asset will move favorably. As the expiration dates approach, the value of the options tends to decline, making time a key factor in option contracts.
The basic functions of financial options. A financial option is a derivative instrument that creates a buyer of the right, but not obligation to buy or sell on the underlying assets at previously agreed price. I now as the price strike price within a specific period of time or the specific date. In exchange for this rate, the buyer pays an amount to carry the premium of the seller of the option. How is assumed the obligation to fulfill the contract if the buyer decides to exercise it. The underlying assets may be the stock or stock index, a current of interest rate, or commodity. There are two main types of options: the call options and the put options. The call options give the right to buy underlying assets in the usage when the inversion is expected to ascend the price to rise. Conversely, a put the game the right to seller and assets in the usage when the price declining is the anticipation. The functional of the options depending on the view of the underlying asset price relative to the strike price. If explication to the option is favorable to the buyer, may dictate the market price allowance for the profit after considering the premium paid. The option is an exercise to sell before expiration. If at vendors, the option simply expired workings of the buyer loves limited to the premium paid. Of the seller, the maximum gains of the game received while the potential risks can significantly depending on the type option sold. Option size mainly used three purchases: healing, speculation, and income generation. In the health option function as a firm is the price the product investment again at present market moves in the speculation, the low investment to the potential for the which. In conclusion, financial options are flexible instruments that allow investors to make the risk rate to take advancement of market expressive. They are changeable by the structure of the right and obligations. They are limited until the cost of the buyer and they usually in both defensive and offensive investment.
Advantages and disadvantages. Among the advantages of options contracts are flexibility to design different financial strategies, limited risks for the buyer, the possibility of obtaining profits with a lower initial investment. However, they also present some disadvantages. They are complex financial instruments. They can generate losses if they are not properly understood. The premium may be lost entirely if the option is not exercised. For this reason, it is important that those who use options contracts have prior financial knowledge.
Today I will explain a simple practical example of call options, including its main data and the final result. In this exercise, we are analyzing an option call contract with two parties, the buyer and the seller. First, let's look at the basic data of the option. The strike price is 100 pesos, which is the price at which the buyer has the right to purchase the stock. The premium paid is for the option is 5 pesos. This amount is paid by the buyer and received by the seller at the beginning of the contract. Now, at the expiration, the spot price of the stock is 120 pesos, which is above the strike price. Because of this, the option is in the money and the buyer decides to exercise the options. Then, again, pay per unit is calculated as the difference between the spot price and the strike price. 120 millions, 100 equals 20 pesos per share. However, the buyer must also consider the premium paid, which is a cost of 5 pesos. Even after paying the premium, the operation remains profitable. The contract size is 100 shares. So the total gain of the buyer is calculated using the contract size. This result is a positive total gain. Will the seller experience the opposite effect? For the seller, the premium of 5 pesos is a gain, but the increase in the stock price generates a loss because they are obligated to sell the stock and the 100 pesos while the market prices in 120. In conclusion, this example clearly shows how a call option gives the buyer a right without obligation with a limited loss equal to the premium and the potential gain when the market price increases.
In conclusion, option contracts represents a flexible financial tool that allows market participation without the obligation to execute a transaction, which distinguishes them from other traditional financial instruments. This characteristic make it possible both to take advantage of making opportunities and to protect against unfavorable price movements. The operation of options is based on clearly defined elements, such as the underlying asset, the strike price, the premium, and the expiration date, which determine the value of the contract and the potential financial outcomes for the parties involved. Understanding these elements helps provide a clear view of the risks and benefits associated with this type of instrument. While option can offer important advantages, such as limited risks for the buyer and greater flexibility in the decision making, they also involve a higher level of complexity. For this reason, their use requires careful analysis, market knowledge, and proper risk management in order to avoid unnecessary losses. In this way, option contracts should be understood as instruments that, when used in an informed and responsible manner, can contribute to more efficient and strategic participation in financial markets.